We have a very interesting guest today. His name is Bret Swarts, and Bret is going to be talking about the topic that's near and dear to my heart, tax advantages and capital gains. But before we get to that, Bret, welcome, and please share with our listeners a little bit about yourself and the venture.
Thank you, Lena, and great to be on the webinar today. So my name is Bret Swarts. I'm originally from California. In fact, we grew up in mostly the Bay Area in Sacramento, helping my parents buy and build houses. We fell in love with being an entrepreneur, owning and managing real estate. And so it's always kind of been from the beginning in the blood, real estate and entrepreneurship. Fast forward, my brother and I are the first to graduate from college. And I also played some basketball in college on scholarship, which was pretty cool. That was one of my passions in life. And then I took an internship at a place called Marcus and Millichap, and it's there where I found how to underwrite properties, how to I know about 1031 exchanges, how to structure deals, how to negotiate deals, and really how to build wealth in real estate because I had a front line seat with my clients who were doing it, and we were the ones that helped to put the deals together. And so, really started out as a real estate investment broker with multifamily properties. But how many of you know that in the 2008 crash, a lot of things changed, right? In fact, we had to look back to find out, what went wrong. And there's a saying by Ray Dalio that says, "Pain plus reflection equals progress." And that pain at that point was the crash of the 2008, financial system. And a lot of people who owned real estate, especially those who had done 1031 exchanges, lost half or all of their wealth because they had too much debt, not enough liquidity, or diversification. Another way to think about it, they didn't have their tax flow and cash flow and debt flow combined. They were just focused on cash flow, and then when things went, kind of sideways, they lost. And so I saw friends, family, and clients lose half or everything over the next couple of years. And this is where we looked around, and my wife and I we were newly married and just trying to make it on our own, as adults. And we had a new baby on the way, and I don't know how many of you been there where you feel like, oh my gosh, I don't know how I'm gonna put food on the table for my family. Well, that's where I was. And growing up, my mom and my dad had a lot of wealth at first, and then the parents got divorced. And when my parents got divorced, my dad kept all of the wealth and didn't pay the child support. And so I grew up with kind of two sides of the world, with wealth and without wealth. And it taught me at a young age that I wanted to have a wealth so that we didn't have the pressure with the family with that. And so that was kind of a burning desire to like work really hard, be successful. And I had been able to do that all the way through my life until this point, in a sense that I was successful in college. And I had, got the degree, and successful in basketball, got the scholarship, and successful landing the Marcus and Millichap opportunity to work there as a career. But then all of a sudden I felt like a failure because the market was, crashed, and I wasn't making any money, and it was really tough. And so I did what every, I think, wannabe real estate or entrepreneur does. You get a side hustle. My side hustle was Cheesecake Factory. And so it was my
Interesting.
wife and I's favorite restaurant. And so nights and weekends we'd work at Cheesecake Factory, and by days I still work at Marcus and Millichap, cold
Wow.
calling, banks and working with owners of their properties. And I'll never forget walking in for that first interview at Cheesecake Factory. Really at this point, feeling, defeated, right? Definitely defeated financially, and but at the same time, like didn't know what else to do, because the pain of the my parents' divorce at a young age and the finances that caused that, all
Yeah, of
of the fears were coming back to me and going, "Oh my gosh, like if I don't make money, like this could be a big problem for our marriage." And so, especially with the baby on the way, right? And so
course.
all of that emotions was building up. And so I worked at Cheesecake Factory, and I also worked at Marcus and Millichap. And it's during that time period that we learned about something called a deferred sales trust, which we're going to be talking about, which changed everything for me and for my clients. Then I have to go through that pain, but also enabled me to earn and build wealth, to be able to keep my wife home full time with our daughter at the time. And fast forward four additional kids, we now have five kids.
Oh,
And now
wow.
this
God
is
bless you.
this is
That's
all we do. We just teach and train people how to build capital gains tax exit plans,
Mhm.
with the sole focus of multiplying freedom and impact. And that's really what it's about. If you own real estate or business or cryptocurrency, a primary home, we can build a capital gains tax exit plan without having to suffer the time consequences of the 1031 exchange. You see, the 1031 exchange helps you to defer the capital gains tax, but it does not help to uncover opportunities and flexibility with your wealth. And that's where the deferred sales trust comes in, which we're going to be talking about today. I was able to retire from the Cheesecake Factory. My wife's home full time still with the kids. And now I'm living in Florida. We moved out of California about a year and a half ago, and
Sure.
our company's called Capital Gains Tax Solutions, so I'm looking forward to diving in more.
That's awesome. That's amazing. Well, it sounds like you moved from one sunny state to another even sunnier state, and I hope you and your wife and your kids are happy with the move and enjoying your new place of home. In
Absolutely, we love it. Yeah.
That's awesome. That's great. And I have many fellow investor friends that have done the same thing pretty much. Moved from their state into Florida and now living their dream and enjoying their lives. Brett, curious, how did you come across deferred sales trust?
Yeah, I was actually sitting at Marcus and Millichap. It was around 2009 now, right? So a lot of the big '07, '08 crash, impact had hit. And now
Mhm.
we're going to the pain plus reflection equals progress. And Marcus and Millichap, for those who don't know, it's like a Morgan Stanley
Yep.
for investment real estate broker, just one of the top in the world of what they do. It's some of the best training. We consider ourselves like the Navy SEALs of investment real estate. So we
Sure.
thought we were on the cutting edge of all capital gains tax deferral, especially 1031 exchange strategies for our clients. We were working with the top 3% of wealth in America that own commercial real estate. Well, I'm sitting in a conference room on a I think it was a random Wednesday, morning. It was a lunch and learn kind of thing. It was a 10 or 12 o'clock lunch and learn. And I remember sitting there, and the glass windows were all, the sun was coming in, and the gentleman was up there talking. And as he began to talk and say, hey, the lack of liquidity, too much debt, the forced 1031, people that are losing properties because they overpaid because they had the short time window. Well, what if
Mhm.
there was a way to not have to suffer all of that? Well, my ears perked up like, well, what do you mean? Right. And so did the other people who were sitting in there. And he went on to talk about this thing called a deferred sales trust. How it's the trust with with an installment sale, 453 installment sale, and how if you combine it and you execute the plan, it's a way to defer tax without having to do a 45-day, we call it the shotgun wedding, when you're running around looking to get married after you just got engaged to a property that you may or may not want to buy, but because of the tax consequences, you're feeling forced to buy that property, and how you
Yep.
don't have to go into equal or greater debt, and you don't have to have the debt sink the ship because you overpaid for the property, and how you could have liquidity and diversification, and in fact you could diversify into stocks, bonds, and mutual funds, or back into other real estate, passive or active, or other business ventures. And wow, I sat there going, if this guy is saying what he's saying, like, this is Netflix and we have Blockbuster. Now, at that time in 2009, there was no Netflix. But if you know the Netflix story, what happened? The Netflix founders approached Blockbuster and said, hey, will you buy it? And they said, maybe, maybe not. They kind of negotiated. Well, all Netflix wanted was 50 million, but Blockbuster said, no, no, we don't want to pay you that. Long story short, Blockbuster's out of business. Now Netflix is one of the leading media companies in the world. And so I had the belief and the faith that if this is true, if this is legal, if this is proven, and if we can learn about this, and this can become the Netflix versus the Blockbuster 1031. And so that was the beginning. It was simply an hour-long presentation. So you're going to get a little bit of that content here today, but it was the stacking and the consistency of studying 10,000 hours with the strategy, with the creator of the structure, who's a CPA and a tax attorney, to really understand how to execute it. Because how many of you know that it's not just the idea, it's the team to execute the idea, right? It's the team to execute the plan that makes all of the difference, right? And so that's what I've come to find out is my passion in life, to execute these capital gains tax exit plans for people that are exiting highly appreciated assets. And by the way, this works for business sales, this works for cryptocurrency, this works for stock, primary homes, and commercial real estate. And we can also save a failing 1031 exchange. Okay. And so this truly works for any asset of any kind, whereas the 1031, remember, only works for investment real estate. That's it. And you cannot diversify into other assets, where ours you can. And so those are just a few of the concepts and how I learned about it.
Awesome, amazing. And Brett, you mentioned that you spoke with the founder himself. So was it the founder of the first sales trust that you met personally?
Yep, it was the creator. Yeah, the creator, the tax attorney and CPA who created the structure, right? Which is so important. If someone's coming to you with a new strategy or a new concept and a new idea, you want
Mhm.
to ask a couple questions. Number one, like, how many of these have been done? Number two, how many have been audited? Number three, what's been the outcome of those audits? Number four, who pays for the audit defense? Number five, is the creator a CPA and a tax attorney, right? Number six would be, what happens if I get audited, right? So these are some of the questions to ask, and those are some of the questions that I would ask. And as I learned, there's thousands of closes, close to 27-year track record, over 29 no change IRS audits at this point. There's lifetime audit defense provided, and essentially, I met someone who I believe is kind of like a Steve Jobs or Elon Musk when it comes to tax. He's a genius, and so created the structure. And not only that, he had executed the structure, had been through the audits, all no change, no finding audits, and it's having a perfect legal track record. And so that began the journey of, okay, if this is true, and I believe it is, I call what's called becoming a believer of the deferred sales trust. Because there's a lot of people out there, including real estate agents or 1031 exchange accommodators, who don't want you to know about this, right? They want to keep you in Blockbuster, and they don't want you to go into Netflix. And the more you can help people understand that it's 100% legal, it's never had it has a perfect legal track record. You have to understand the nuances, right? There's a third party unrelated trustee, that's our role, or a third party unrelated trustee helps to execute the trust on a day-to-day basis. There's, ongoing fees that are involved, but once you understand those three things and how it works and how to make the DST an investment and not an expense, the rest of it becomes easy, really does, once you do the first one. Just like the first time you do a 1031 exchange, or the first time you did a multifamily syndication, or you raised capital. Like at first, it's a bit complicated until you have a group to help you. But then once they help you, it's not so complicated. It's actually easy. And so that's what we do. We help people kind of make simple the deferred sales trust so they can execute it on their next exit.
Interesting. So let's uncover some of the things you mentioned and cover some of the questions. So you mentioned that it doesn't usually trigger audit, but if there is an audit, there is typically no red flags that come out from this audit that's triggered by the deferred sales trust. And it sounds like the strategy is about, you said 28 to 30 years old at this point, more or less. And also correct me if I'm wrong, my understanding based on what you shared with us, this strategy is sort of an alternative to 1031 exchange. So if someone doesn't want to defer their taxes, rather wants to find a way to avoid the taxes altogether, then there is this legal way called deferred sales trust that allows you to skip 1031 and move on without owning any taxes or having the kids owe any taxes in the future. Is that correct?
Okay, so let's start. Oh, let's start with there's a number of questions there, right? So let's start with this. So what's the deferred sales trust legal track record? Okay, so it's close to 30-year track record, thousands and thousands and thousands of closes, billions and billions and billions of gross asset sales have sold using the deferred sales trust. And there's been over 29 no change IRS audits. And this includes federal audits, state audits, promoter audits. Okay. There's been third-party national law firms that have reviewed this and given it the thumbs up. There's been third-party previous IRS agents that are also now tax attorneys that basically do private legal opinion letters for people that are exiting and looking at this. Been approved by those individuals. This is not something that you're going to find in the IRS tax code. Also, the IRS is not going to put like a rubber stamp on anything. All of our audits have been no change, no findings. So perfect legal track record, detailed audits. One of the biggest audits was over $120 million deal in California. Most of our audits have been done in California. And so it has a perfect legal track record because it's just an installment sale with the trust. You would know it, or we would know it as a seller carryback, right? But we're adding a trust, and that's the creativity here that we find out, and we'll talk about how this works. But yeah, it's batting 1,000 when it comes to the track record. And as far as the avoidance, it's not tax avoidance, it's tax deferral. Now, it is avoiding the 1031 exchange, right? So you can we have to say you can eliminate the need for the 1031 exchange. Okay, so eliminate the need for the 1031 exchange. It's tax deferral, and that you will pay taxes as payments go back to you. By the way, a 1031 exchange also does not avoid tax. It tax defers it until when? Until you receive payment from that investment and you don't have enough depreciation to offset the cash flow. You will pay tax. But even then, depreciation is also not tax avoidance. It's tax deferral. Okay, now because you're lowering the basis, right? You're lowering the basis. Now, to kind of finish this point, if you pass to kids, if you get a stepped up basis, one of the advantages of the 1031 exchange is you get what's called a stepped up basis. If you own the real estate and you die, your children can get a stepped up basis if properly structured, okay? Which is powerful because now the basis jumps up to the today's value, Okay. And that means you could sell at today's value and have no capital gains tax because the basis has been stepped up. The deferred sales trust doesn't have a stepped up basis, but you can have the promissory note, which is what this is structured on. That can be passed to heirs, and the heirs can step into your shoes and continue the tax deferral. Okay. And so you got to look at the pros and cons to these things. But here's the reality: most baby boomers and most people that are selling today, businesses or other assets, they're ready to be time freedom, right? Stress freedom. No more toilets, trash, termites, all of the rent controls and all of the tough reasons why it's hard to own in New York and New Jersey and California, some of the major states that are just a lot of regulation, right? And so if you could sell those assets, defer that tax, increase your cash flow, which by the way, we're typically able to increase by 40, 50, 60 times, 70% cash on cash return because we can take what's locked up of equity, move it into other assets, pay off the debt from the sale, and then invest into assets that are producing excess cash flow, which is huge for people because a lot of people want to retire. They want cash flow now rather than just having a property or a business that's highly appreciated where all of that gain, all of that capital is locked up. And so, yeah, we build these plans, we execute the plans, and I think it answered all your questions there, but let me know if I missed anything.
I think you pretty much answered the questions I asked in the past. So let's dive into the mechanics of the process on a high level, of course, because we only have so much time within this interview. But on a high level, Brett, take our listeners through the steps one has to go through to execute the first sales trust. And since majority of our audience are real estate investors, if you were to gonna use an example, use example of some sort of commercial real estate to make it easy and more relatable for them.
Absolutely. By the way, people can pick up the book, Building a Capital Gains Tax Exit Plan, which on page 56 has an entire breakdown. And I'm going to kind of zoom in there
We
so
can see.
you can see it, right?
Yep.
And I'm going to use just a real simple example for a transaction. Let's just imagine an Alina. Where are you located again?
I am in New Jersey.
Okay, so New Jersey, one of the highest tax states in the country, right? I think it's actually number one. And I think New York and California
You're
are kind of
right.
like number two. It's brutal, right? By the way, we just helped the New Jersey client exit a dental business, and they were able to defer about $800,000 of tax. And imagine being a dentist in New Jersey for the last 25 years, right? And you started your practice from scratch, and this is your entire retirement, and you're about to pay about at least 40%, 45% of the gain, state and federal, in tax, right? And so his basis was zero. He sold it 2 million. Well, he's able to defer all of that capital gains tax, and it went into basically a retirement account. Charles Schwab is typically where the funds go, and now it's invested into passive real estate, also some stocks and bonds, and it's diversified. And he's living off the income from this trust, but it's an extra $800,000. So I want everyone to capture like what we're doing here, right? We're deferring that tax and we're letting the full amount work for this particular seller, and that can be you as well. You can defer the tax and let it work for you, and then he gets to live off the cash flow of the full 2 million that the interest is earning. And we typically earn somewhere around 6 to 10%, 6 to 9% net of fees. We're earning about 9 to 11, maybe 12% total, but net of fees are about, 8, 9, 10%, depending on how we structure the note, depending on the risk tolerance of the client. And that's the beauty of this, right? And so if you have an extra amount working for you, okay, so how does this all work, right? So step one, there's an asset to sell, and the sale of this asset, or you wanted to sell it, is worth at least $1 million and has at least $1 million of gain, right? So it's a big enough gain. And so what do we do here? We set up a trust, okay, and let's call it, Alina, let's call it the New Jersey Nets Deferred Sales Trust, or DST. Okay, it's a made up name. It's going to be a single entity, and it's only going to do business with Alina. Okay, and Alina, let's imagine you have a $10 million apartment complex, right? You've owned it for 30 years, so it's fully depreciated. To keep it simple, let's say you have no debt. Okay, so zero debt on the asset. And also keep it simple, let's use a 40% capital gains tax rate. Okay.
Sure.
Although be very aware, Biden is proposing to raise the federal capital gains tax rate from 20 to 44%.
Yeah.
It doesn't
Yeah.
count for state, okay? So just be aware of that. Like, this could go higher. And also be aware that the stepped up basis may or may not always be around. They're also proposing to take that away. Okay. If you haven't caught already, the government has a spending problem, which means we all have a tax problem, right? And so
And there
Okay,
is a
so
depreciation recapture tax on top of it.
yep, an additional, right? And so it could be just a really painful situation. So we're talking 63, 70, maybe 75%. It just makes it not worth selling, right? Unless you can defer the tax. Okay,
Absolutely.
they're also talking about limiting the 1031 to about $1 million if you're married or 500 single for the tax deferral, which kind of eliminates that as well. Okay, so back to the scenario. Elena, you have a $10 million multifamily complex. You have zero basis. If you were to sell, you're going to have 6 million net after tax, or you can have 10 million with the trust deferred. Okay. So what we do is we set up a trust, and this trust is basically going to be inside of the escrow. I mean, it's going to be an option for you. Okay. An option. We're going to put language into a contract that gives you the option to be able to sell it to the trust prior to the trust selling it to the buyer. So you go find a buyer for 10 million. To also keep it simple, let's say they have 10 million cash, but they can come with a loan, but you're not going to finance the buyer. You're going to finance the trust. You're going to first sell it to the trust for 10 million, and the trust is going to turn around and sell it for 10 million. So what happens there, Lena? If the trust bought and sold for 10 million, what's the gain on the trust?
Zero.
You got it. Is there tax on zero? Zero. Okay. No, no tax at the trust level. Now, if you receive 100% of a note, meaning you get a promissory note and you take no payment at closing, you're in a deferral state. You did an installment sale with the trust. At closing, how much do you owe on tax? Or how much is triggered? You still owe the four, but it's deferred. You see how that's deferred because you haven't taken any payment?
Right, right. So you
Okay.
don't know anything at this point.
You got it, right? Now that 10 million, where's it coming from? Well, it's coming from the buyer. The buyer's putting the 10 million because the buyer bought it from the trust. So the
Mhm.
10 million hits the Charles Schwab account for the new trust account. And this new trust owes you the money, Alina. Okay. And let's just call it at 8%, $800,000. Okay. So this 10 million gets invested. The buyer is gone. The buyer has the property. He's gone, right? And this 10 million is now sitting in a money market account at 5%, a lending fund at 10%, maybe another multifamily property with you that you want to buy, or a passive deal you want to go into. It could be into a fund. It could be into cryptocurrency. We had a client buy about a portion of Bitcoin at 40,000 a coin about a year and a half ago, and it
Mhm.
went up, as we know today, about 65,000 a coin. Pretty cool. So you can
Yep.
start to diversify. You can dollar cost average, but when do you pay tax? Well, you'll pay tax as the payments come out to you. Now, what are the payments? Well, the payments can be structured in a couple different ways. One, it could be partial interest payments. So you might take four or $500,000 of interest payment and let the other amount accrue. Okay. And you'll start taking that, monthly, divided by 12 monthly distributions or quarterly. You might even delay it for a couple of years, right? You might delay it, and then when you delay it, you let the $800,000 just accrue each year, and then start taking payments in year three. That's a kind of a common way that we structure it. But do you see how you're deferring tax because it's in this trust that you sold it to on an installment, and this is how this whole thing works.
Excellent. So, Brett, couple of questions on that. Number one, why create a note to the trust? Why not create the note to the seller and seller finance it?
Right, great question. So why not do a regular installment sale versus the deferred sales trust? It's a great question. In a regular installment sale, you're financing the buyer, which is kind of two or three major things that are challenging with that. Number one, that buyer is not investment grade. What does that mean? Well, that means they may or may not be, creditworthy. They're certainly not as creditworthy as someone like a Home Depot or a Walmart or a Costco. Meaning, what is your collateral secured against, right? A lot of people have done traditional installment sales where they secure it against the old asset, and they say, "Well, I don't necessarily mind if the buyer is investment grade or not. I might take back my asset." Well, do you really want to do that? Is the next question, right? Are you selling just to to get out of all of it, just to find out in 2 or 3 years when the buyer doesn't pay, you have to take it back. And even worse off, if you take it back, they probably haven't run it very well, right? That's why they haven't made the payment. And the property is probably undervalued now. It's in disarray. They start over, with new management or whatever. You have to fix a bunch of problems. So when you finance a traditional buyer, the biggest problem is the risk that's associated with having to take the asset back, especially at an inopportune time, just when you're getting your stride in retirement, right? Second thing is a lot of these interest rates are structured at 4, 5, 6% maybe. You know, a lot of them, they're not even as high as the traditional one. This is part of why the buyer wants you to carry paper, right, for them, because they can get a little bit better deal. They're also typically not structured with any kind of prepayment penalties in place. Although it doesn't mean you can't structure with that. But the point is, a lot of these things are short in nature. They're 1, 3, 5 years typically, right? And then they're going to pay you off anyways, and you're going to pay the tax anyways. And the deferred sales trust, they're 10-year notes that every 10 years you can renew for 10 years and renew for 10 years and continue to renew it and go for as long as you want. So do you want a note structure that only goes for 1, 3, or 5 years, or do you want one that can go for a long time? The next part would be just liquidity, right? A lot of people who are selling, they want the ability to access the cash. That means paying the tax. That's great. Well, if you finance the buyer, guess what? Your cash is all tied up into that one single asset that's not diversified, that's not liquid, right? And again, it's probably maybe paying you 4 to 6%. Whereas on the deferred sales trust, you are liquid. You can be diversified. You can also go into illiquid assets. And we can typically get excess, again, 6, 7, 8, 9% net of the recurring fees. So you're increasing your cash flow, you're decreasing your risk. And your collateral can be secured against some of the biggest companies in America. It can be secured against some of the biggest companies in the world. It can go into cryptocurrency, right? It can go into passive real estate funds. It can go into mobile home parks. It can go to multifamily self-storage. It's just so much more robust, right? This is why we call it Netflix, and this is why we call it versus the blockbuster regular installment sales.
Interesting. So let's dive a little bit deeper, Brett, if you will. So you answered one of my questions that I had in mind, that it's not bound to Wall Street. You can go to Main Street as well and buy stuff outside of Wall Street, which is great. Gives people an ability to diversify if they decide to, and buy products on the stock market and buy some real estate, Bitcoin, whatever they believe in. But then the next question that comes to mind is, as far as the distributions, are they taxed at the capital gain rate, number one? And number two, as you invest your money and they accrue, it sounds like at that point, the income is not taxed only at capital gains. There is some that can be taxed as ordinary income and some that can be taxed as capital gains. Am I understanding it correctly, or is there a different way to
Yeah. So
treat?
how's the deferred sales trust tax? Okay. So one of the top questions you want to make sure you understand if you're looking at the deferred sales trust. And there's really two things to understand. You have principal and you have interest. Okay. Principal and interest. Well, the principal is taxed at capital gains tax if and when you dip into principal.
Okay.
The interest is taxed as ordinary income tax if and when you take interest payments from the trust. And
Okay.
so most of our clients are structuring these with interest only payments or partial interest payments, whereas the interest is coming in, they're paying ordinary income tax. They get a 1099 on that. So let's do an example. Let's say you had a $10 million exit and you had an $800,000 of interest that's accruing every year. Well, if you only take $500,000 of interest from that and let the other 300 accrue, you'll get a 1099 for $500,000. And so you'll pay $500,000. You'll report that as income and you'll pay tax on that. Now let's imagine you took 800,000 when you get an $800,000 1099. Now let's imagine that same year you actually took $1 million, right? Well, when you're dipping into principal there, right? How much? $200,000 of principal. So you'll get a 1099 for $800,000 on the interest that you received, and then
Yeah.
that 200 will be principal, and you'll pay capital gains tax on that principal. And so you got to make sure you understand what you're taking when you're taking. Now, here's the reality: most of our clients structure it with partial interest payments, and they're typically not dipping into the principal, meaning they're not dipping into it personally. Okay. However, they can partner with the trust. And this is really powerful. Okay. Understand this. You can be an active owner in real estate. Okay. By partnering with the trust and using the trust as a silent joint venture partner. Okay. Now, this is not taking it personally. Therefore, you're not paying tax on this. This is a deferral of the tax still. In fact, the trust can invest into passive or active real estate with you as an active entrepreneur, real estate owner, or developer, or passively with others, or some combination of both. Again, you can go into stocks, bonds, mutual funds, cryptocurrency. You can go into lending. You can do a number of things. You go into business ventures. And the key here is understanding that as long as it's in the trust and moving jointly with you into a real estate or investment purpose, it's in a tax deferred state. as it makes personal payments to you, principal interest, you're going to pay some capital gains tax or some ordinary income tax. So hopefully that helps you understand the differences between how and where the deferred sales trust, as it pays you, you'll be taxed.
Yeah, Brad, it makes perfect sense. So, interesting you mentioned that you can partner with your trust to invest in real estate. And let's use a hypothetical example. You partner with your trust, and you want to invest in a syndication that's 506C. Uh, how do you qualify trust as an accredited investor? Is
So
there a
how
way
does
to
the yeah, so how does the trust qualify as a as an accredited investor, right?
qualified
And
purchaser? I mean, maybe one or the other.
yeah, so let's start with this one. So how does the trust qualify as a accredited investor? Okay, and so there's a part of the accreditation kind of rules and regulations that states that any entity of which all of its equity owners have basically $1 million net worth, qualify to be an accredited investor. And so this entity, as long as is everyone that's associated with it has $1 million net proceeds, it qualifies as an accredited investor. And this is the neat part, you can go right into the investment. So whether it's an LLC or a trust, an entity can be an LLC, an entity can be a trust, right? So that's the entity part of it, and it has $1 million. All of these equity owners have at least $1 million net worth, qualifies it to be an accredited investor as the entity, and so the entity can go right. So what this means is, regardless of the investment, if it requires a qualified accredited investor, you can just go. The trust can go right into that investment, just like any other investor would go into this. So that's how the trust qualifies as an accredited investor.
Excellent. Brett, you mentioned a few minutes ago that you called Deferred Sales Trust, for short DST. And I know some of our listeners, when referring to DST, think of Delaware Statutory Trust. Can you help our listeners understand the differences between the two?
Yes. So a Delaware statutory trust, also known as the old DST, is a 1031 exchange that's basically a syndication, okay? Where you as a active real estate, owner can 1031 exchange into a passive Delaware 1031 is a good way to think about it as well, and be able to defer the tax. Um, but these have some challenges to them, okay? Number one, you give up all control. Number two, you give up all liquidity. Number three, you give up all diversification, right? And number four, they're huge fees. Sometimes as much as 10 to 15% of every dollar you put in is going to be hit with a fee. The last part is its timing. You're, doing the sell high, buy higher 180 days later, typically, right? You're buying in the same market. In fact, in 2008, the market took 3 years for the real estate market to shift to its low point in 2011. Right now, it's a different market. It was mostly residential that really got hit there, but also commercial. And this scenario, we're more in a commercial real estate reset, and so we're going to see it take more time here, right, to shift. But the point is, if you're looking for, also you have to replace the debt. Okay, so it forces you to stay in debt. Although the Delaware, you can get non-recourse debt, meaning the debt could be in the sponsor's name. But they're the old blockbuster way of doing things. Now, we like them for a few reasons. If you're going to do what's called you have a debt over basis challenge, okay? Debt over basis challenge with the investment real estate that you're selling. We actually we work with financial advisors that can structure these where they have these groups that have lots of debt, like an Amazon tenant, and we replace that debt over basis, and then we do the rest of it. We can go into the deferred sales trust, and so the deferred sales trust is what's called the new DST, or the Netflix to the old blockbuster DST, and this allows you to be debt free, diversified. You can have liquidity. Yes, there are fees. The fees are about 1.5% to 2% on a recurring basis. Okay, and about 1.5% on the setup fee up front on the gross sales price.
Of the
And so,
proceeds or of the
we'll go into fees. We'll go into fees. Yeah.
Okay.
Okay. And so there are fees about 1.5% on the gross sales price, and then upfront one time, and then about 1.5% to 2% on a recurring basis on the net proceeds into the trust. So there are some fees here, but the key here is you have liquidity, diversification, and no more debt. Okay, you don't have any more debt, and the best part is you have time on your side. So you can buy when it makes sense. You can dollar cost average, right? You can buy into other asset types, right? You can diversify, and that's the beauty of the deferred sales trust. It puts the leverage of tax flow, cash flow, and debt flow on your side because you have time to work with. And timing is the most crucial aspect of investing.
Awesome. And Brett, as far as the assets, we already know that it's either Wall Street or Main Street. Are there limitations? In other words, does the client choose where they want to go, or do you give them a basket and say, here are the eggs, choose one or two or five?
Great question. Yeah. So we work with certified financial planners at times for clients that want a balanced approach to the deferred sales trust. And I think it's wise to do that. And they specialize in financial planning. They specialize in, stocks, bonds, mutual funds, and building out what's called traditional investments in the stock market and securities. And that's one part of the team that we definitely want to have in place. However, we also work and we consider ourselves a real estate investment advisor, meaning that we are searching and vetting and looking at real estate funds. We're looking at real estate syndications. We are actually having our own deals that we're putting together with our clients, and collectively, we're trying to do a balanced approach. We also have clients that are very entrepreneurial, and so you might be listening, saying, "Well, I'm an entrepreneur. I want to run and build my wealth." Great, you can partner with the trust, and you kind of like a self-directed IRA. You can run and build properties, build businesses, and invest into businesses in real estate or lending, something along those lines. That's a great way to do it, right? And so we want to keep a balance to this as well. We typically keep some liquidity. A good rule of thumb is about 20% liquidity for the trust assets, and that can still be in stocks, bonds, mutual funds, or short-term debt instruments to help keep that liquidity, in a nice conservative spot, right? Versus going all into one thing, one property all at once. And so this is part of what we're going to build the capital gains tax exit plan. We're going to kind of show you where the guardrails are at. But whether you're an entrepreneur or you want to be retired, we can do both. But also, even the person who wants to be more retired, they're going to look and approve of every investment. So nothing's ever going to move without your approval or your signature. You must approve of the investments. But the biggest thing is to have a tax flow, cash flow, and debt flow mindset, and then use the deferred sales trust as the tool. But then the actual business team members, right, the professionals, as the trustee, real estate investment advisor, financial planners, work with your CPA. Collectively, we're going to execute the deferred sales trust, but you have to approve of all the investments.
Awesome, very nice. And I just thought of another question. I don't know if you necessarily had this situation, but I'll ask anyway. You mentioned business owners. So let's say it's a physician that own a business and the real estate, because in our case, a lot of the folks own real estate. And they decided that after 25 years, it's final time to sell it. So they sold both the business and the real estate. Both proceeds went into this trust. And so if they haven't touched it, they're not paying taxes at this point, right? If they haven't withdrawn any money, correct?
Correct. You're in a deferral state. You can defer a business sale and you can defer real estate. We just did a business sale for a seller out of Alabama, a multi-million-dollar business sale, and he deferred all of the tax. And then he partnered with the trust, and he started to build 70 multifamily units in Tennessee, all tax deferred. We also did a real estate strictly sale in Colorado. It was a $5 million multifamily property sale, and they use our DST 2.0, which we should touch on, to eliminate the estate tax, right? Because one of the biggest challenges that we're all facing, or those that are worth more than basically 6 to 7 million single, or 12 to 14 million married, as of 2026, is the death tax. And you don't want to get caught off guard with the death tax thinking that the stepped up basis is going to solve it for you, because it's not.
It's
Stepped up
not,
basis only has to do with capital gains tax. And so
right.
we want to eliminate that estate tax. And so the DST 2.0 can do that. In fact, you can sell and defer capital gains tax and simultaneously eliminate the estate tax. And so I'll give you an example. Let's imagine you happen to be worth $114 million and you're married, really simple. And you own all of that apartment complexes in New York and New Jersey, okay? And you're fully depreciated, right? And you may or may not be thinking that, oh, I just get a stepped up basis. My kids can walk away tax free. No, they can walk away capital gains tax free, but they cannot walk away estate tax free. In fact, they'd give you that exemption of about 14 million as of 2026, that the other 100 million be subject to a 40% debt tax, which is $40 million. And so here's the solution: without any charity, life insurance, or gifting required, while you're still alive, you sell the asset and you use a DST 2.0, and we eliminate that estate tax forever. And your kids can be the beneficiaries, and your kids can inherit estate tax free and typically capital gains tax free, all without having to use a 1031 exchange, all without having to give it away to charity or having to buy a bunch of life insurance or gift it away. It's a remarkable structure and strategy. In fact, one of the biggest deals that this was done with was over $120 million deal in California that was audited, no change, no findings. And so, yeah, you can learn more about that. You go to capitalgainstaxsolutions.com.
Awesome. Very nice. Very nice. Brett, two questions that we usually like to ask our audience at the end of the interviews, and you partially answered. The first one is where our audience can find you. It sounds like it's capitalgainstaxsolutions.com, but if there are any other social media handles, feel free to share
Yeah.
and we'll put in the notes as well.
Yeah, so BretSwarts.com as well has all of our, access to the book, has access to our best 1031 exit plan. By the way, we also say friends don't let friends do a 1031 exchange without a backup plan, and we can save a failed 1031. We've done multiple Delaware statutory trusts with deferred sales trust and regular 1031s. Sometimes each deal requires multiple strategies to execute it. And so you go to BretSwarts.com to get started there. And that's BRETT SWARTS.com. And that'll give you access to the best 1031 plan, the book, capital gains tax solutions, and also all the social medias with LinkedIn, Facebook, X, and Instagram are the main ones.
Yeah, well, thank you. Thank you. You're certainly a wealth of information, and I'm sure our audience will enjoy reviewing the resources you shared. And the final question that we also like to ask our audience is, how do you like to give back?
Yeah, here at Capital Gains Tax Solutions, we exist to unlock capital gains to multiply freedom and impact. And so there's a couple ways I'd like to give back. Number one is families' time, energy, stress to make an impact with their lives, right? And to make an impact with their time and to make a meaningful impact to give back to what we call the MVPs. And the MVPs are those that are most vulnerable people in this world, right? They're those that are lost, forgotten, stolen, those who have been taken advantage of, and those that society as a whole, we need to go and rescue and help. And so one of the things that are really close to our heart is those that are facing trafficking, right? And those who are again lost, stolen, and forgotten. And so we have a heart for giving there and being on the front lines by providing capital to fund projects like that they're going to help those that have been sold into trafficking. So those are just a few of the ways that we multiply freedom and impact and what we're committed to doing here at Capital Gains Tax Solutions.
That's an amazing purpose, Brett, and thank you and your team for doing that. We really appreciate it. Brett, it's been an amazing interview. Thank you so much. For our listeners, please check out Brett's resources and definitely reach out for any tax-related help. It sounds like Brett and his team can do an amazing things and help you not only to save on taxes, but save you on several headaches that you may have in your back pocket. Thank you, Brett.
Thanks,
Bye.
everybody. Bye.